Each year, we comprehensively review our long-term outlook, identifying the investment themes and asset class forecasts that underpin our portfolio construction. We expect artificial intelligence, the pursuit of new energy sources, and persistent global trade to drive markets. Over the next 10 years, we are forecasting higher bond returns and moderate equity returns versus the previous 10 years. Let's take a closer look. Our confidence in AI lies in its potential longer-term productivity boost versus shorter-term adoption. Near-term gains may come in spurts or may be muddied by other data. We believe AI adoption and gains will likely be evident longer-term as the technology is adopted and use cases are refined. Globalization may have slowed, but it has not reversed. Geopolitical tensions are morphing supply chains and trade pacts, likely leading to risks and opportunities over the next decade. This may present investors with the opportunity to be increasingly selective. The world is still highly integrated, leading us to view further fragmentation as a risk, but not a foregone conclusion. Global energy demand continues to increase and requires a robust set of options, innovations, and finance mechanisms. Countries are seeking to satisfy surging demand for energy, secure more energy independence, and meet commitments to slow climate change. To do so, many are diversifying their energy sources, improving energy technology, and securing raw material supplies. We incorporate these themes along with other long-term market and economic trends to develop our 10-year forecasts across asset classes. For stocks, divergence in the performance of U.S. and non-U.S. markets has been prevalent over the past 15 years, and we expect that U.S. equity markets will continue to outperform. We expect returns of developed ex-U.S. equities to lag those of the U.S. for the coming 10-year period. While their price-to-earning multiples have been attractive, our outlook for slower economic growth doesn't support any significant expansion in these markets. Despite solid sales growth, profit margins, dividend yields, and attractive valuations, emerging markets have delivered lower returns versus developed markets since the global financial crisis. Heavy share issuance, most notably in China, has offset those strong fundamentals, suppressing stock performance, and we expect this trend to continue. In the bond market, we expect lower cash yields and steeper yield curves to shape returns over the next decade. We expect credit spreads to rise, though they will likely stay below historical averages. We anticipate that slow to moderate economic growth will persist and that inflation should stay largely in check. Short-term rates are likely to decline early in the 10-year investment horizon, followed by a modest yield curve steepening later. Over the next decade, adoption of AI, new energy sources, and adjustment of trade partners will likely drive divergent paths in economic growth globally. We expect decent equity returns, improved bond performance, and moderate economic growth to drive portfolio performance. Our 10-year forecasts call for a 6.4% annualized return on average for a portfolio with 60% in global equities and 40% in U.S. investment-grade bonds versus the 6.8% annualized return over the past 10 years for the 60-40 portfolio.